Welcome, focused learners. Today, we're diving into a very special explainer designed just for you. We're going to explore the complete life cycle of a corporate entity by following a fictional company on its journey. But we aren't just looking at standard business concepts today. We're actually going to master some advanced financial vocabulary, slowly and deliberately. I'll be speaking at a measured pace right from the start so you can easily follow along. Our goal here is to deeply understand these terms by connecting them within a real-world story rather than just treating them like isolated flashcards. So get comfortable, focus in, and let's embark on this financial language journey together. Okay, here's our roadmap for today. First, JSC basics. Second, shares and dividends. Third, profits and losses. Fourth, bonds and capital. And finally, contracts and differences. Let's jump right in.
Section 1. JSC Basics. Forming the foundation.
All right, to start our fictional company, we need two foundational terms. First up is joint stock companies. Let's practice that slowly. Joint stock companies. Once more, joint stock companies. Imagine a business owned entirely by its investors. That is a JSC. Now, who exactly runs it? That brings us to our second term, General Meeting of Shareholders. Say it with me. General Meeting of Shareholders. Again, General Meeting of Shareholders. This is the absolute highest decision-making body where those owners gather to vote on major issues. Now, when that general meeting of shareholders actually decides to start the business, they need foundational money. We call this the charter contribution amount. Let's repeat that. Charter contribution amount. One more time. Charter contribution amount. This term refers to the precise initial capital that the shareholders officially agree to put into the business to get it off the ground. To truly lock this into your memory, let's read a clear English explanation out loud, nice and slow. The chartered contribution amount represents the initial capital committed by investors to establish the company. By really grasping this sentence, you understand the exact starting point of our corporate story. Section 2. Shares and dividends. Managing payouts. As our company grows, we run into two highly connected terms. First is preference shares. Let's practice it. Preference shares. Again, preference shares. These are special stocks issued to early investors. And why are they so special? Well, because they usually come with our second term, mandatory fixed dividends. Let's say it. Mandatory fixed dividends. Once more, mandatory fixed dividends. This basically means the company is legally required to pay these preference shareholders a set amount of profit regularly. It creates a guaranteed income stream. Sometimes, though, instead of paying out dividends, a company decides to take stock back. The term for this is treasury shares. Repeat with me. Treasury shares. One last time. Treasury shares. This happens when the company actively uses its own cash to buy back its stock from the open market. Let's reinforce that concept with a clear, contextual sentence. Read along with me, slowly. Treasury shares are shares that the company has bought back from investors. Keeping this sentence in mind helps you remember the exact action our company is taking with its wealth. Now, our company might also allow shares to change form. The first term for this is market price conversion. Let's practice. Market price conversion. Again, market price conversion. This is when converting a financial instrument is based on current market rates. But as we know, markets are risky, and that leads directly to our second term, uncontrollable variability. Repeat it. Uncontrollable variability. Once more, uncontrollable variability. Because the market changes so wildly, the final converted value is subject to fluctuations that the company simply cannot manage. Section 3. Profits and losses. End of financial year. The end of the year finally arrives, and we see the story of corporate accounting unfold in three distinct steps. Step 1 is closing profit and loss. Repeat that. Closing profit and loss. Again, closing profit and loss. This is where the accountant finalizes the year's numbers. If there's a profit, they move to step 2, reserve appropriation. Practice that. Reserve appropriation. Once more, reserve appropriation. They deliberately set a portion of the money aside. And this action builds step 3, equity reserves. Let's say it. Equity reserves. Again, equity reserves. These are the crucial safety net funds held directly within the owner's equity. But what if our fictional company actually lost money this year? We have to contrast two very different outcomes. The first is a lucky scenario, loss subsidized by a superior body. Repeat that. Loss subsidized by a superior body. Again, loss subsidized by a superior body. This means a parent company stepped in and covered the negative balance. The much harsher reality is the second term, unabsorbed loss. Say it, unabsorbed loss. Once more, unabsorbed loss. This is a deficit the company carries heavily on its own shoulders. Let's solidify the meaning of this negative financial outcome. We'll read this explanatory sentence together with the serious tone it deserves. An unabsorbed loss remains on the balance sheet because it has not yet been covered by profits. It just sits there, an unabsorbed burden, waiting for future good years to wipe it away. Now, while the accountants are figuring out all these year-end profits or unabsorbed losses, the money needs a temporary home. That brings us to our next term, interim holding account. Say it with me, interim holding account. One more time, interim holding account. This is simply a temporary bucket where funds sit safely while all the final financial processing occurs.
Section 4. Bonds and Capital. Banking Requirements.
All right, now let's imagine our company interacts with a massive bank. We need to understand how these next two terms rely entirely on each other. First up, bank subordinated bonds. Practice it, bank subordinated bonds. Again, bank subordinated bonds. A bank issues these specific, lower priority bonds to investors to raise cash. Why? Well, to satisfy our second term, regulatory capital. Let's say it, regulatory capital. Once more, regulatory capital. The government actually forces banks to hold a certain amount of wealth to remain safe, and issuing that subordinated debt helps them hit that mandatory target.
Let's take a brief pause and now firmly grasp this legal banking concept by reading the definition together, slowly now. Regulatory capital is the minimum amount of capital a bank must hold by law to ensure its financial safety. It's really all about protecting the entire financial system.
These financial instruments, like bonds, move through a timeline of different statuses. First is indefinite term. Say it, indefinite term. Again, indefinite term. This means there's no fixed end date to the agreement. Second is outstanding. Repeat, outstanding. Once more, outstanding. This means the balance is currently active and unpaid. And third is suspended. Say it, suspended. Again, suspended. This implies the bond is temporarily halted or stopped from operating.
Section 5. Contracts and differences, agreements and gaps.
In our final scenario, our company enters into some pretty complex agreements. First is contractual obligation. Repeat that. Contractual obligation. Again, contractual obligation. This is a strict legal requirement. Second is mandatory redemption. Say it. Mandatory redemption. Once more, mandatory redemption. This means being legally forced to buy something back. Third is intentional difference by agreement. Let's practice. Intentional difference by agreement. Again, intentional difference by agreement. This happens when parties knowingly agree to account for something differently. Finally, merger differences arising. Repeat. Merger differences arising. Once more, merger differences arising. These are the complex financial gaps that appear when two companies officially combine. To really highlight the sheer legal weight of that first term, let's read the explanatory sentence nice and slow. A contractual obligation is a duty that a company must fulfill according to a legally binding agreement. It's not a choice, it's a mandate, legally enforced by the courts. Finally, let's look at two modifier words that completely alter how we view a financial statement. First is genuinely. Say it, genuinely. Again, genuinely. We use this to describe a transaction that truly represents real economic substance. Now contrast that with mere. Repeat, mere. Once more, mere. We use mere to dismiss something as just a simple bookkeeping entry, without true economic weight. Think of it like a genuine profit versus a mere accounting adjustment. We've traveled all the way from the birth of a joint stock company right through to complex merger differences. By taking our time today, you've heard the pronunciation multiple times and learned the contextual business logic behind each of these words. So my final question to you is this. Are you ready to apply these advanced financial terms in your next business meeting? Keep practicing this slow learning method, review these terms, and speak with absolute confidence. Until next time, keep learning and keep growing.